Amazon generated over $575 billion in revenue last year. But more than half of its operating profit came from a division that most customers never interact with. If Amazon shut down its online store tomorrow, the company would shrink. If it shut down this division, the empire would collapse. It's not the store. It's the servers. The misdirection. Most people experience Amazon through a cardboard box. Free shipping. One-click checkout. Endless selection. It feels like a retail company that mastered logistics. And that's exactly what Amazon wants you to think. Because retail generates attention. But infrastructure generates power. To understand Amazon, you have to separate revenue from operating income. Because those two numbers tell completely different stories. Revenue is not profit. Amazon's revenue is dominated by retail. North America retail and international retail together account for the majority of total sales. Historically, well over 70% of consolidated revenue. But retail margins are thin. Warehousing, transportation, robotics, aircraft fleets, returns processing, inventory risk. This is a capital-intensive business. Even in strong years, Amazon's retail operating margins typically sit in the low single digits. In some periods, international retail has posted operating losses entirely. Now contrast that with Amazon Web Services. AWS often represents only around 15 to 17% of total revenue. But in many fiscal years, AWS has generated the majority of Amazon's total operating income. Operating margins in AWS have historically ranged between 25% and 35%, compared to retail's low single digits. That is not a side division. That is the profit engine. If revenue is the headline, operating income is the truth. And Amazon's truth lives in the cloud. The origin of AWS. In the early 2000s, Amazon was facing an internal problem. Its engineering teams kept rebuilding the same infrastructure components over and over. Storage, compute capacity, database services, payment processing layers. Jeff Bezos pushed a mandate. Every team must expose its functionality through APIs. Infrastructure had to become modular. That decision did two things. It standardized internal systems. It made those systems exportable. In 2006, Amazon launched AWS. The pitch was simple. Instead of buying expensive servers and maintaining data centers, companies could rent computing power on demand. This converted capital expenditure into operating expenditure. Startups loved it. Enterprises followed. Today, AWS powers streaming platforms, financial institutions, government agencies, healthcare systems, global startups. Switching away from AWS is not easy. Cloud infrastructure embeds itself deeply into architecture. This creates switching costs. Switching costs create durability. Durability creates margin stability. Follow the profit split. Let's put the numbers in perspective. Imagine a simplified scenario. Retail generates $400 billion in revenue at a 3% operating margin. That produces $12 billion in operating income. AWS generates $90 billion in revenue at a 30% operating margin. That produces $27 billion in operating income. Retail looks bigger. AWS makes more money. This is why Amazon's valuation narrative is cloud-driven. Investors do not price Amazon like a retailer. They price it like infrastructure. The marketplace transformation. But AWS is only part of the ledger. Amazon made another structural shift over the last decade. It moved from selling its own inventory to hosting other sellers. Today, more than 60% of units sold on Amazon come from third-party sellers. That shift changes risk. When Amazon sells first-party inventory, it carries product risk. It holds working capital. It absorbs unsold stock. When third-party sellers sell, sellers carry inventory risk. Sellers pay referral fees, often around 15%. Sellers pay fulfillment fees. Sellers pay storage fees. Sellers pay advertising fees. Amazon becomes the toll collector. Inventory risk moves outward. Fee-based revenue moves inward. The more sellers compete, the more Amazon monetizes visibility. Amazon does not need to own the products. It needs to own the marketplace. Ownership of the road matters more than ownership of the cars. Advertising, the hidden accelerator. There is another quiet transformation. Amazon is now one of the largest digital advertising platforms in the world. When sellers want visibility, they bid for placement. Sponsored listings, top of search results, featured positions. Advertising revenue carries dramatically higher margins than retail. This transforms Amazon from a store into a marketplace, a logistics network, a cloud provider, and an advertising exchange. Visibility becomes auctioned. Traffic becomes monetized twice. Prime as a behavioral lock. Amazon Prime is not a shipping program. It is a behavioral conditioning system. For an annual fee, around $139 in the United States, customers receive fast shipping, video streaming, music gaming perks, exclusive discounts. Prime members spend significantly more per year than non-members. Once someone pays the subscription, the psychology changes. Each purchase feels discounted. Each search defaults to Amazon. Prime reduces friction. Reduced friction increases frequency. Frequency strengthens marketplace dominance. Marketplace dominance strengthens AWS demand from sellers. The flywheel spins. The flywheel economics. Jeff Bezos described Amazon's model as a flywheel. Lower prices, more customers, more sellers, greater selection, lower costs, lower prices. But the public flywheel hides a deeper one. Retail scale, seller dependency, advertising monetization, data optimization, AWS infrastructure leverage, profit concentration. Retail is the outer ring. Cloud is the core. Capital allocation strategy. Amazon reinvests aggressively. Why? Because low retail margins are strategic. By compressing prices, Amazon weakens competitors, expands its logistics moat, deepens Prime adoption, increases seller dependency. Meanwhile, AWS generates the cash flow. This cross-subsidy allows Amazon to operate retail at lower margins than most competitors can survive. Retail attracts attention. Cloud funds the war. Competitive context. In cloud computing, Amazon competes primarily with Microsoft Azure. Google Cloud AWS historically held the largest market share globally, often in the low 30% range. Cloud computing itself is a high-growth sector. Enterprises are migrating infrastructure off-premises. Digital transformation accelerates demand. Retail growth may slow. Cloud demand compounds. This is why analysts track AWS margins more closely than retail revenue. The future valuation multiple depends on cloud durability. The real business model. So what is Amazon? Not a store. Not simply a logistics company. Amazon is an infrastructure provider, a marketplace landlord, an advertising platform, a subscription lock-in system, a cloud computing giant. Retail is the funnel. AWS is the vault. Marketplace fees are the toll. Advertising is the accelerator. Prime is the glue. If you removed the cardboard boxes, Amazon would still exist. If you removed the cloud, it wouldn't. The hidden ledger. The package on your doorstep feels like the product, but it's not. The real money flows through server racks, seller fees, subscription lock-in, advertising auctions. Amazon does not win because it sells everything. It wins because it owns the infrastructure others depend on. This is Hidden Ledger, the numbers behind power. If you enjoyed this, subscribe. I post every week.